Right now, Plug Power, ticker PLUG, is trading live at $2.705, and it's down about 2% on the session as of 10:45 a.m. Eastern. The stock is volatile, bouncing between a low of $2.64 and a high of $2.74, and it's doing so on significant volume, with nearly 28 million shares already changing hands. Now, the immediate expectation when you see a stock like this, one that has fallen from highs of over $70 a few years ago, is that this is just the sad final bleed out of a failed company. But the reality is that this 2% drop isn't just noise, and this isn't a company that's quietly fading away. This is the epicenter of one of the market's biggest and most controversial bets. The price isn't moving because people are suddenly souring on the idea of hydrogen. The price is moving because the market is holding its breath, waiting for a single press release from the Department of Energy that will either send this stock soaring or bankrupt it. This isn't a growth stock right now, it's a binary bet on a government loan. Here's the common ground we all share. Almost everyone who has been involved in online investing, especially in the last 5 years, knows Plug Power. For many, this was the green energy play. People using the Robinhood app or SoFi Invest saw this as the next Tesla stock. The expectation was that Plug would be to the hydrogen economy what Tesla was to the electric vehicle market, a vertically integrated giant. They see a stock that was once $70 now trading under $3, and the temptation to buy what looks like a 95% off sale is overwhelming. But this is where the reality check comes in, and it's a brutal one. This is not a simple buy the dip situation you'd add to your Fidelity IRA. The hard reality is that Plug Power is in a desperate fight for survival. The company's own filings earlier this year contained the dreaded going concern warning, which is financial speak for, "We are running out of cash and may not pay our bills." This isn't the kind of stock you'll find in a stable, diversified portfolio like Schwab Intelligent Portfolios. This is a high-risk, speculative name that professional traders on platforms like Interactive Brokers are watching, not for its long-term disruptive potential, but for the massive headline volatility. Let's break down the recent market action, because it's all that matters. This stock is not trading on its fundamentals. In fact, its fundamentals are, to put it mildly, disastrous. The company has a history of missing earnings expectations, as we saw again in August for its Q2 results, where it missed EPS estimates. We're now heading into its Q3 earnings, expected around November 10th or 11th, and the market is bracing for another loss, with consensus estimates around a loss of 13 cents per share. But even that isn't the main story. The entire focus of every single institutional investor and every retail trader doing their self-investing is on two things: the cash burn rate and the DO loan. As of the last quarterly report in midsummer, the company's cash position was dwindling, down to around $140 million in cash and short-term investments, and its quarterly cash burn from operations was nearly $200 million. You don't need to be a math genius to see that those numbers are not sustainable. This is a company that is, by its own metrics, running out of time. This is why the Department of Energy loan is everything. Plug has an application in for a $1.66 billion loan guarantee from the LPO. This loan was announced as finalized back in January of this year, a lifeline that was supposed to fund the construction of up to 6 of its green hydrogen plants. And yet, here we are at the end of October, and the market is still waiting. This delay is the source of all the toxicity and fear surrounding the stock. Every day that goes by without that capital infusion, the cash burn continues, and the company gets closer to a liquidity crisis. This 2% drop today isn't about hydrogen production in Georgia. It's about the fear that the loan has hit a snag, or that the new administration's policies, like the One Big Beautiful Bill Act mentioned back in July, are creating bureaucratic hurdles. The bull case for this stock, the only bull case, is that this loan closes, the cash hits the account, and the going concern issue vanishes overnight. The bear case is that the loan fails, and Plug is forced into a catastrophic company-ending dilution by selling billions of new shares at these rock-bottom prices, or it simply goes insolvent. It's a bizarre situation. The stock has actually rallied significantly from its 52-week low of 69 cents, driven by hopium on this loan, and some positive operational updates, like its Georgia plant hitting record production. But analysts are completely divided. You have H.C. Wainwright with a $7 price target, implying more than 100% upside, believing the European market and rising electricity costs will save the day. And then you have Citigroup, which has reiterated a $0 price target, a 75% decline from here based on the brutal reality of the cash burn. This isn't a situation like analyzing Apple stock or Nvidia stock, where you're debating PE ratios and forward growth. This is a 0 or 7 scenario. It's no wonder the analyst consensus is a hold, which in this case is just a polite way of saying, we have no idea. So, what does this company actually do that has it burning so much? The original expectation and the core business for years was selling hydrogen fuel cells primarily for forklifts to big customers like Amazon and Walmart. But management's big plan was to vertically integrate. They didn't just want to sell the fuel cells, they wanted to produce and sell the green hydrogen to power them. This led them to build a massive, capital-intensive network of hydrogen plants, like the ones in Georgia, New York, and Tennessee. Here's the fatal flaw in that reality. They are selling this hydrogen at a loss. They are spending more to produce the hydrogen than they are selling it for. This means that every bit of revenue growth they report in their hydrogen fuel segment is actually increasing their losses. It's a leaky bucket, and the only way to fix it is to achieve a scale that is so massive that the production costs fall dramatically. That, again, requires the $1.66 billion from the DOE. This is not a stock for a beginner. If you're just opening an individual brokerage account or looking at Fidelity investments for the first time, this is not the place to start. The stability you'd find in Fidelity ETFs or Fidelity mutual funds is the polar opposite of what Plug offers. This is the kind of stock that chews up accounts on the Robinhood app. People see Robinhood fractional shares as a way to buy a cheap lottery ticket, but they fail to understand the sheer financial distress the company is in. A sophisticated investor using the Interactive Brokers platform might be playing the options on this, betting on the volatility, but they aren't likely building a long-term position in their Fidelity Wealth Management portfolio. This is a trade, not an investment. The company has become entirely untethered from its own operational performance and is now just a proxy for a political and bureaucratic decision in Washington. I have to ask, because this is the only question that matters for this company right now. Comment below with what you think is more likely by the end of next year. DO loan approved and the stock is over $5, or loan denied and the stock is under $1. Looking forward, the future for Plug Power is a knife's edge. It is the clearest example of expectation versus reality in the entire market. The expectation, the dream, is a $3.2 billion market cap that becomes the backbone of a new clean hydrogen economy. The reality is a company with $140 million in cash that is burning nearly $200 million a quarter, all while its survival hinges on a loan that has been imminent for 10 months. The catalysts are simple. A positive loan announcement would send this stock flying. A confirmed finalization of the funds would remove the going concern risk and give them the runway to try and make their economic business model finally work. The risks are just as simple. The loan is denied or delayed indefinitely. If that happens, the company will face a checkmate scenario. They will either enter insolvency or be forced into a dilutive financing so large it will permanently crush shareholder value. So, as we watch Plug dip 2% today to 270, remember what you're seeing. You are not watching a high-growth tech stock like Nvidia stock taking a breather. You are watching a high-stakes, all-or-nothing bet play out in real time. The expectation is that this is a pioneer on sale. The reality is that this is a company on financial life support, and the market is getting very, very nervous that someone is about to pull the plug. Disclaimer: this content is for informational purposes only. It's not financial advice, so don't make any decisions without doing your own research or consulting a professional. Be smart with your